Kia ora, and welcome to the CoreLogic Property Market Update for Mahuru, September 2023, brought to you by Loan Market. The Aotearoa property market recovery appears to be underway, but we should still expect variability in the short term and restrained growth over a longer horizon. While at the nationwide level, the CoreLogic House Price Index saw a minor decline of 0.2% in August, multiple markets experienced an uplift over the month, including Heretaunga, Hastings, Kapiti Coast, Ōtautahi, Christchurch, Herewini, Selwyn, Queenstown Lakes and Waihopai in Invercargill. Meanwhile, a few key parts of Tamaki Makaurau, Auckland, Manukau and North Shore, and both Te Awa Kairangi Uta, Upper Hutt, and Te Whanganui-a-Tara, Wellington City in Wellington, posted gains for the second month in a row. It's worth recognising the total drop since peak was the greatest in these larger centres, with Wellington region values down 21.7% from peak, and Tamaki Makaurau, Auckland, down 17.5%, though they are still well above COVID levels as well, 14.1% and 17.7% respectively. Sales volumes have also started to pick up, though admittedly off a very low base. Total agreed sales in the past 3 months are 8.6% up on the same time last year, with the year-on-year comparison exceeding 10% in Tamaki Makaurau, Auckland, Kirikiriroa, Hamilton, Tauranga and Ōtautahi, Christchurch. While the flow of listings has also started to lift, it has not yet been enough to offset the increase in sales activity. However, the falling trend in total stock through winter does look to have come to an end. Given the signs and now evidence of increased demand, helped by greater interest rate certainty and loosened LVR and triple CFA settings, alongside still low listing supply, it's no surprise that we've seen an effective end to property value falls in some parts of the country. First home buyers have remained relatively active through winter, but investors too appear to be making their way back from the sidelines. Reserve Bank lending data shows they've already taken advantage of the reduced deposit requirement. And with the election poll-leading National Party confirming their tax plans to reinstate interest deductibility over a phased period, some property investors may bring forward purchase decisions to get ahead of the election result. The likely introduction of debt-to-income restrictions around April next year could also encourage some investors to get in sooner if they're worried about the potential impact to their borrowing power. All that being said, affordability pressures are likely to keep somewhat of a lid on demand, even into next year. For a new entrant, roughly 50% of the average household's income is required to service an 80% LVR mortgage, and high prices, combined with high interest rates, are limiting the available yield on investment properties. This means it's still going to prove challenging for existing investors to extend their portfolio, even with interest deductibility reinstated. All of this is to say we're expecting a more gradual upswing than we've seen in the past, as any uplift in demand is likely to be muted due to those affordability constraints. Of course, with a strong labour market, very high net migration, and a weakening, though seemingly resilient construction sector, the fundamentals still support growth in residential property values. Perhaps just more in line with incomes, at least until interest rates start to fall again. As we all follow the election campaigns into the October election day, make sure you stay across all the latest developments in the market and follow our news updates on the CoreLogic NZ social channels, including LinkedIn, Facebook, Instagram and Twitter. And download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.